Welcome to the monthly economic update. I'm joined today by Bob Cunneen. Welcome, Bob.
Thanks, Jason.
Well, I think we've finally seen the US congressional approval of President Trump's tax plan. So how have markets reacted to that?
Well, markets have anticipated largely what has been implemented in December. So President Trump and Congress approved a very dramatic cut in the corporate tax rate from 35% down to 21%. And the American share market has responded during the course of last year by rising at a plus 20% type return.
So what we've actually seen is the US markets have hit record high and on very low volatility, one of the lowest that we've seen for a long, long time. So what have US markets actually done?
Well, we've seen a strong rally since the lows in 2009. And we haven't seen any significant correction in markets for the last couple of years. And that is giving a very low volatility reading. And essentially markets are very optimistic that with these lower corporate tax cuts, you're going to see very strong profit results out of American corporations. Combine that with a very solid American economy, so consumers are spending, unemployment rate is low, there's a very positive sentiment about the American share market.
And do you think it's just really weight of money that's causing that volatility to be quite low?
Well, it is essentially that, the market has positioned itself for a buoyant American share market. So you can say in the sense that is the weight of money in terms of positioning, and the further the market goes, the more and more money is drawn into the market. So the weight of money gets bigger and bigger.
And what do you expect the US Fed will be doing in 2018?
Well, the Fed, in terms of the central bank, will continue to raise interest rates. Last year in 2017, it raised interest rates 3 times in total of 0.75%. Now, the Fed has given the same projection for this year to continue raising interest rates, but it has emphasised it will be gradual. However, we need to be careful that if the American economy is doing so well, the share market's at record highs, unemployment is so low, the potential inflation risk is quite significant. Therefore, the Federal Reserve can surprise by raising interest rates more aggressively.
So turning attention to Australia, economic data has been more mixed. How has the Australian market performed over the last month?
Well, in December itself, we had a good solid return of plus 1.8%. And we got some more encouraging data in terms of retail sales picking up, consumer sentiment, which had been a weak point in the Australian economy, is also improved. And the labour market, we're continuing to generate some very strong jobs growth. So we seem to have ended 2017 on a very positive note.
With all this positive news around, what are the risks that you're worrying about at the moment and you think investors should consider over the coming year?
Well, firstly, that the Federal Reserve will raise American interest rates more aggressively. The second aspect is the political risk in America. So President Trump is under investigation, the Mueller Commission, in terms of Russian collusion. We've also got congressional midterm elections in November of 2018. So the perception that these corporate tax cuts are permanent might be challenged later this year with some of that political risk. Also, we have to be conscious that China is tightening financial conditions. So what we're seeing is that interest rates are gradually rising in China. So we have to be conscious that'll put some downward pressure on China's growth rate. And for Australia, if things are improving in terms of economic activity, consumer sentiment, retail sales, the risk is that the Reserve Bank may contemplate raising interest rates later this year. So that may be a surprise.
Great, well thanks Bob. And thanks very much for joining us today.